How's it going, everyone? Welcome back to another dividend investing video. The pains continued through September with all major indexes down, and here we are retesting those lows from back in June. But with all that pain comes opportunity. As dividend investors for the long term, this should be seen as a wonderful chance to accumulate quality businesses at a discount. Don't get discouraged, my friends. This is a long-term game. We're talking decades. I've been doing some research, and I've wanted to share 4 amazing companies I believe are seriously undervalued and look great for the month of October. This is the Dividend Growth Income channel where we love investing, especially dividend growth stocks, as a powerful way to grow your wealth. I'm Nick. Thank you for joining me today. Dividend investing is your thing, or if you want to learn more, click that subscribe button. Also, if you could please smash that like, it would really help out our little channel, spreading our love of dividends. Please don't just buy into these companies based only on this video. Use it as a springboard to further your own research. I'm not a financial advisor or guru. I'm simply a guy who loves dividend growth investing and wants to share my love of dividends. Investing in the stock market is risky, so always do your own due diligence. So these 4 stocks have 4 things in common. First, they all look ridiculously undervalued. Second, they all grow their dividend at an annual rate of 10% or greater when looking back at the last 5 years. Third, they're all at or very close to their 52-week lows. And finally, I own all of the stocks here myself and have been buying them actively. So I'm putting my money where my mouth is. So let's get to it. And stick around until the end of the video. I will share 3 additional companies that I think are undervalued and warrant a spot on your watch list for the month of October 2022. First up, we have United Parcel Service Inc., ticker UPS. UPS is an American multinational shipping and receiving and supply chain management company founded in 1907. With a $142 billion market cap, UPS is the largest courier company in the world by revenue, ahead of competitors DHL and FedEx. Additionally, they operate a chain of retail stores called the UPS Store, and that assists with UPS shipments and provides various tools for small business. UPS is down huge lately, and I believe this has very little to do with the fundamentals of UPS itself, but more that it's been brought down by its peer FedEx and their own issues. Now, FedEx is down even harder and perhaps also at a value, but I happen to believe UPS is the higher quality company of the two, and for dividend growth investors, there is a better track record. Now, UPS's current share price is in the mid 160s, and its 52-week low is 160.13, which we were at just last week. Been a very painful month for us UPS shareholders, with an almost 17% drop in just the last month. Year to date, it's down about 23%. UPS is trading at a PE of only 12.7, which is a good bit lower than its 5-year average of 15.8, as well as the sector average of 14.6 for industrials. Now, at the time of publishing, shares of UPS are yielding 3.69%, and this is 18% higher than its 5-year average of 3.13. UPS pays its dividend quarterly every March, June, September, and December in the amount of $1.52 a share. With an earnings payout ratio of 47% and a free cash flow payout ratio of 41%, the dividend looks to be well covered by both metrics. Simply Safe Dividends provides a safety score of 69, which is considered safe. The dividend growth solid, averaging 6% over the last 5 years. The growth has stalled over the COVID pandemic, perhaps. They were being responsible due to all the unknowns, but the latest increase was 49%, and I would call that a company that is committed to dividend growth investors. And revenue is up year over year like clockwork. In 2012, they brought in $54 billion in revenue, while in 2021, they did $97 billion in revenue. Outstanding shares have also declined nicely over the last 10 years, going from 969 million in 2012 to 878 million at the time of publishing. The number is up slightly over the last few years, so it doesn't look like they've been doing any buybacks recently. UPS has $24 billion in debt, and they have $12 billion in cash on their balance sheets. I think UPS is a great opportunity for investors looking for both dividends and price appreciation. This is one of those buy and holds forever for this investor. But if you were to buy into UPS, I think more pain could be expected, especially if there's any kind of prolonged recession. Moving along, we have company number 2, Rowe Price Group, Inc. Based in Baltimore, Rowe Price is a global investment management firm with a $24 billion market cap. They offer funds, advisory services, account management, and retirement plans. They currently hold over $1.34 trillion in assets. Now, you may find some of their funds in your own 401k plan. They made their name with the mutual fund, the Rowe Price Growth Stock Fund, and as their funds are heavily in growth stocks, they have been beaten down especially hard with the overall market. Now, Rowe is trading in the mid to high 100s, right at its 52-week low. In the last month, TROW has been down 10%. Year to date, it is down a massive 45%. It's a remarkable decline in this bear market. Rowe Price is trading at a PE of 13.2, which is a few points lower than its 5-year average of 15, which is good. It is well above the financial services sector average of 8.8. Now today, your TROW shares are yielding 4.5% yield, nearly 75% higher than its 5-year average of 2.6%. Those dividend payments are made quarterly in the months of March, June, September, and December, and they pay $1.20 per share. This is a secure dividend from all appearances. Simply Safe Dividends gives us a safety score of 94. The payout ratio is edging high at about 59%, but the dividend only makes up 33% when looking at free cash flow. TROW as a company has shown a great commitment to growing its dividend with a consecutive increase streak of 35 years, and this dividend has grown at a rate of 15% per year over the last 5 years. Impressive. Revenue has been steadily increasing, although it looks like there is currently a slight drop in revenue in the last 12 months when compared to 2021. Now, outstanding shares have been on the decline since 2014, when they had 267 million shares outstanding, and today they are sitting at 228 million shares outstanding. So the buybacks look pretty consistent for the last 5 years. Hopefully they're taking advantage of the fact that right now they're at a historical low. One thing I love about this company is they have virtually no debt. There's only $300 million of debt, which is easily covered by the $2.12 billion of cash on their balance sheet. There is so much to like here, and this stock has been beaten down bad. And I do believe there could be a couple tough years ahead depending on how the market goes, but I love this play for the long term. For company number 3, we're going to take a look at Home Depot Inc., ticker HD. The Home Depot is the largest home improvement retailer at a $273 billion market cap. They operate stores that sell building materials, home improvement products, lawn and garden products, and home decor. You probably know this already about Home Depot. They also offer installation services and tool and equipment rental. They primarily serve homeowners, general contractors, and other maintenance professionals. They're currently trading in the high 260s, right near its 52-week low of 264.51. Home Depot is down around 9% in the last month, and year to date, they have dropped 34.25%. Now, Home Depot's forward PE is 15.8. This is far below its 5-year average of 21.2. This one usually trades a little more expensive. Home Depot does also trade more expensive than the consumer discretionary sector as a whole, which trades at 11.5 currently. Now, the current dividend yield is 2.83, which is 25% higher than its 5-year average of 2.26. The only time in the last 5 years it's been higher was during the COVID crash of March 2020, but it recovered very quick from there. They pay out their dividend quarterly at $1.90 per share, with payments issued in the months of March, June, September, and December. This looks like a safe dividend with a 45% payout ratio. That payout ratio typically hovers around that mark pretty consistently. The Simply Safe dividend score is 89. Dividend growth has been spectacular. We have 13 years of dividend growth, and over the last 5 years, it has grown at an average rate of 18%. And the latest increase was announced at 15%. Let's see more of this. And it helps that Home Depot is growing their revenue at a very fast rate. It has doubled in the last 10 years. In 2013, their revenue was $74.8. In the last 12 months, they've done $155 billion in revenue. Home Depot has a history of aggressively buying back their shares. In the last 10 years, shares have decreased about 33%. Well, this one might not be quite a discount as some of the others in this list. With Home Depot, you're getting an extremely quality company at a good value, and it's not very often this company is this cheap. And I, myself, am a buyer. Company number 4 is Comcast, ticker CMCSA. Headquartered in Philadelphia, Comcast is the largest American multinational telecommunications conglomerate with a $140 billion market cap. They are the largest cable TV company, the largest internet provider. They own NBC Universal, DreamWorks Animation Studios, and they even own the Philadelphia Flyers of the NHL. Comcast has really taken a hit in 2022. In the last month, it's down around 17%. And year to date, it is down 46%. Currently hovering at its 52-week low, right at $30. It's trading at an 8.3 PE, which is quite a drop from its 5-year average PE of 14.2, and it's a good bit lower than the sector average of 14.9. Comcast is yielding 3.5%, which is nearly 80% higher than its 4-year average of 2.02%. We have never been able to buy Comcast at this kind of yield. The dividend is paid out quarterly. Right now, it's 27 cents per share in the months of July, October, January, and April. And do note that upcoming ex-dividend date of October 4th. I believe this dividend is very safe with a Simply Safe dividend score of 89. The payout ratio is 30% in terms of earnings and 28% in terms of free cash flow. What I like here is this ratio is quite consistent over the last 10 years, and that number has remained in the high 20s and low 30s. And this is particularly nice to see when you look at how fast they grow this dividend. That growth rate is, over the last 5 years, averages at 13%. The latest dividend raise was 8%. So I think high single-digit increases can be expected to continue well into the future. Their current streak is at 13 years of consecutive dividend raises. Their revenue has been growing steadily over the last 10 years. They have $62 billion in revenue in 2012 and are now doing $122 billion. They buy back their shares. In 2012, they had 5.43 billion shares, and today they have 4.58 billion, and that looks great. Debt is a concern with this company, as it is pretty much every company in this business. They carry a little less than 100 billion in debt, and that's Comcast. I do think it's worth a spot on your watch list, and perhaps I'll do a proper valuation of this one in a future video if there's enough interest, because I really think they're at a very intriguing spot. As promised, my friends, here are 3 additional companies that I believe are very intriguing at or right below the current level. I consider these to be very high quality companies, and I own 2 of them. The first is O, Realty Income. It's dropped below $60 recently, which puts it at a 5% yield, and I love it at this place. This was on my buy list below $67, so I'm buying this one up here and there. I think it's worth a look here for those monthly dividends. Another one for your watch list is Target, ticker TGT. The consumer retailer is down 36% year to date and looks to be retesting that 52-week low. If you can get it under $144, you'll have it at above a 3% yield. And their latest dividend increase was 20%. And I think we're going to see more of that going forward. And one more for your watch list is Texas Instruments, ticker TXN. Big fan of this one. It's one of my largest holdings, and I really like it under 160. The company fires on all cylinders in terms of dividend growth and share buybacks. The most recent dividend increase was just announced a couple weeks ago, 7.5%, and this is my favorite play in the semiconductor space. I would add it to your watch list and look to potentially add on dips if it passes your due diligence. That is it, folks. Thank you so much for sticking with me here. Please check me out on Twitter at DivGrowthIncome, and let's connect. And for full disclosure, I am long Comcast, Home Depot, Realty Income, Target, Rowe Price, Texas Instruments, and UPS. And I hope your October is full of happiness, joy, and dividends. And until next time, folks, keep investing.